Well, welcome everybody. Glad to have you on here for our I Love IRR webinar. We're representing the orange loud and proud today. So appreciate you hopping on. I know we have a good slate of participants on here today. So let me start with just thanking everyone for hopping on. For those that do business with us, we appreciate every opportunity to be able to work on cases with you. For those that are hopping on here that maybe don't work with us and if are seeing some of the things we do and trying out, hopefully there's some good stuff there and we can set up a one-on-one conversation after this. And maybe I might actually have a couple of my students from my class on here. I don't know if any of them are still out of bed and can hopping on an IRR webinar as part of their class, but they're all welcome. And hopefully we have a couple on here today. So without that, let's kind of get started, right? I mean, today we're talking about IRR. And IRR is really an exciting topic for me. If you know, really, right, everything that I talk about is the fact that I love IRR, right? We are in February. It's Valentine's Day. There's hearts galore. Hopefully, some of you received your I Love IRR t-shirt. If so, feel free to take a pic of yourself in the photo and send it over to us. Either text me or send it to us over on email. We'd love to see you repping the gear. I don't know if it's something you wear out to Costco or when you go to the beach, but definitely, hopefully you can throw it on and shoot us a photo. So excited for that. So let's get started with the presentation. I'm going to take my orange glasses off. Let's get this going and get moving because everyone's got a busy day today. So let's rock and roll. I'm going to share my screen. Make sure everything's rolling forward here. All right. Looks like we got a good screen. Looks like everything's there. So a lot of you probably have heard me talk about IRR. This is going to be some walkthrough of some of the basic concept of what it is and what it means and why we use it and how you can use it with your clients. Hopefully kind of bring it full scope. So one thing I know in our introduction email or our invite email, we asked you for a few questions. We got a good couple dozen questions in advance. So that's awesome, awesome, awesome. Most of them actually probably make their way into the presentation and have kind of weaved it into what we're going to go through. So they should be discussed. If not, or you have other questions along the way, you'll be able to click into that chat or the Q&A box, and that'll prompt up on my screen. If I don't see it, I have Darian on our team. You can see we have a fabulous production of marketing going on here. She'll get those questions to me, and hopefully we can answer them during the presentation. If not, we can set up a time and go through it. Okay, so that's housekeeping item number one. Second is in the Zoom platform, you're going to see in the bottom, or I don't know, maybe it pops up to the top or the bottom for you. We're going to share some resources. We're going to have a poll or two along the way, but we're going to have a lot of the PDFs and the presentations available to you. So you don't have to take any screenshots or anything like that. You'll just be able to click on that link and download it. All right. So with that, I'd say let's get rocking, right? We're going to talk about IRR, better way to plan. Okay. So when we talk about that, what do we mean, right? Well, that's me. Okay, cool presentation. All right, let's talk about IRR. We're going to talk about what is it. We're going to talk about the form itself, why advisors should use it as a baseline. And then we're going to look at it actually in action. Okay. So we're going to see how it plays out. Again, if you work with us, you probably have seen that. So let me stop for a moment here. We're going to pop open the poll. Who on the webinar here has used IRR? Should be pretty easy, pretty quick, just a little quick click. If you've used it or not used it, just getting a good gauge. All right, we're up to 40, 50, 60 responses here. Awesome, great work. 70, we'll give it a couple more seconds. I think our law of large numbers is starting to hone in for us here. Okay, so it looks like about 75% of the people have said yes. 25% of the people have said no. Those are that's the 25%. I'm glad you're on here because if you're using it, you probably know how excited we are about it and how you can use it. If you're not, hopefully this gives you some ideas of how we can benchmark it and put it into practice for you. So thank you for participating in that. Again, a lot of good stuff that's going to come from it. Well, let's step back and just ask, what is IRR? I actually put this shirt on this morning, and Ellen, my wife, says, "What is IRR?" So I already had to start the presentation this morning. Internal rate of return is what IRR is. There's a lot of different terms or definitions or acronyms for it. It could be rate of return or return on investment. The uniqueness to why I use IRR, I guess, is the fact that there's an embedded internal rate of return. The rate of return or the return on investment is more of a true investment language where, that's going to be equal to the growth you earn on the asset, if like an accumulation asset. An internal rate of return is going to be a little bit more actuarial based because there's embedded benefits that you have within the product that play out over time. So it's a little bit, I'd say, again, that idea of it being internal versus an external return. But in the end, to me, I call it the great and powerful equalizer. It is like opening or pulling back the curtain of the great man at the Wizard of Oz, right? It takes away all of the things that we see with insurance products, and the power and equalizer aspect of it breaks it down to a single number. So by definition, IRR is just an actuarial metric used to assess the profitability of a cash flow stream, right? I think you heard me say this many, many times. These things are about money in and money out, right? You give money to the insurance company gives you money back. And there's three ways that you get money back from any insurance policy. That's the actuarial triangle. You live with your money, you die with your money, or you quit with your money, right? So again, you quit with it, that's the cash surrender value. You're liquidating the insurance contract. You die with it, that's the death benefit. That's what gets paid when you die. And then to live with it is generally the living benefit that you get from whatever form of insurance it is. If it's an annuity, living with it is a lifetime income stream. If it's long-term care, living with it is the acceleration of the benefits to pay for long-term care, okay? So again, money in, money out, live with it, die with it, quit with it. And IRR just allows us to measure what that money or that exchange is worth, all right? From an advisor standpoint, you can use it to now start to benchmark, analyze, and compare all the different cash flow streams that are available to you, right? There's different amounts. They may come to you in varying levels. They start at different times, right? You can't do traditional accumulation math when you're actually taking distributions along the way because there's a time value of money component. And really for us, it just takes all of that extra, the marketing, the collateral that insurance companies have, the roll-up rates, so the bonuses and the payout factors, and just takes all of that noise out of the equation and brings it back to what money did you put in and what money are you getting back, and it brings it to a single data point. We generally operate, when you think of returns, you think in terms of single numbers, right? If you say, what's the return on a bond? You're going to say a number like 3 to 4. If you're going to talk about the return on equities, you're going to say 7 to 8, right? Like it's just instinctual. When we talk about return, you generally go to a number. That does not exist when you think about insurance, because insurance is about loss protection. You are transferring a risk that you don't want on your balance sheet, and you're buying a contract and transferring that risk to an insurance company. So we have a fabulous blog coming out talking about risk management and how you use that in your financial practice. Okay, so that's a key one that's going to be shared here in the next day or two. So when I talk about time value of money, I'm not going to go too much into the equations here, right? But time value of money, I think we all get the basic concept in its simplest form. Understand there are always 5 components to making the time money change values. And some of those are often simplified. They may not be coming into play, right? If you had $100 today, and let's say we didn't add any money to it, so we're going to plus 0, and you grew that money at 5% for 1 year, you know your $100 growing at 5% would then equal a future value of $105, right? Like that's pretty easy, straightforward, simple math, right? And so when you have 4 of the 5 of the pieces of the equation, you can always solve for the 5th. So like in our example there, we had the present value of the 100, we had the payment of the 0, we had I equals 5% and N equals 1, right? And so when you do that math and put it together, I can then solve for the 5th item. And that's generally how we do accumulation math, okay? So, you know, in this example, we have those 4 pieces of the equation and we're solving for the future value. But you can change or switch those up in any given way, right? When you have a mortgage and you're looking for an amortization schedule. I mean, remember the day they used to print out amortization schedules and it showed all 360 months and how your value changed over time, right? There, you know, you had a future value of 0 on the mortgage. Let's say your current mortgage was 100K. That's the present value. Your interest rate on the mortgage was, back when things were great, is at 3%, and N is equal to, let's just say, 30 years, right? When I have those 4, I can do the math and switch here, and I can solve for what is the payment for your mortgage. So hopefully everybody's kind of getting that idea that if you have the other components, you can always solve for that last one. So I do see a quick question here. And it's so appreciate you hopping in there. If there's more, again, type them in along the way. In what situations would you use IRR over net present value? Okay, it's actually a great question that comes up right here on this page. In a general term, I would say that they're actually being used at the same time. All right, the net present value calculation comes from this time value of money equation. Net present value is just the situation where I don't know what it is worth today. Sometimes I'd say, and this is where, again, if we think more accumulation money, we're going to look to see what is this NPV today. If I know, well, what is it worth in the future? How much payment am I getting or withdrawal, right? Payment can always be in or out, so it could be plus or minus. The difficulty sometimes with net present value is I have to make an assumption here on what I is, right? You have to have some hurdle rate or some assumption of what you would have earned on those cash flows during that time. Now, if you have a certain calculation where you know you would exactly earn 5% on the money, it's easy. You would put 5% in there for I, right? And so that's straightforward. And you would then be able to solve, you know, bring the future value back, bring it back at interest at the number of years, and you would be able to solve for net present value. But often, like in what we're going to talk about here, we don't know what this is. And often we don't know what I is because I'm not certain what N is going to be, especially when it comes to insurance, because N is like that triggering event. When does it occur? And so if we kind of just rearrange the formula here a little bit, right? Like we'll do a little magic, the actuarial magic there. This is the same formula, but shifts them around and shows, again, if I have a future value, and I have a present value and a payment, I have an N, I can then solve for what I is. And this is the spot where I have the ability to not have to guess what rates of return I might earn in the future. I'm actually going to make these items known and drive the scenario back to, if I know what those are, well, what is the implied I of the values that I'm actually getting? Because now I'm going to convert I back into the way that I think for that accumulation money, right? Bonds 3%, equities 8%, insurance contract IRR equals X%. So let's go through a couple examples, right? Before I got an example, I got another summary slide. Sorry about that. Businesses use IRR to decide investments. Honestly, insurance companies use IRR to determine whether the annuities or life insurance or long-term care that they write to millions of policyholders, they use IRR to determine their level of profitability because they don't want to guess the future return on investments like an NPV would. They would actually project out what the investments are and when they get them, and then say, what is that inherent return embedded in those cash flows? Again, advisors, you're going to use it to compare things, and you're going to use it to compare anything we talk about. So even though we bring up an idea and we say this annuity has a particular IRR, right? That's the example here that we can use it for any cash flow. All right. And then the last is, clients or individuals use it all the time in time value of money. It's just in a simplified form. Okay. I do see another question here, and I'll kind of hop into it just before I go into the example. Is, have I asked ChatGPT or IRR about, ChatGPT or AI? I'd probably use Grok on X.com. About IRR and net present value. Have they been accurate? I don't think I explicitly have recently, but anything that I've looked at, in those auto-generated, computer module-based platforms, AI, I think they're generally accurate when it comes to talking about what is the net present value of money. I think that's key. Does it understand how to apply it in form of insurance? I don't know if it's quite there yet, right? I think there are some ChatGPT things that actuaries have looked at, and they're not always dead on because there's different assumptions on how people think there. So the data set might not be always kicking out the most concise answer for you. But great question. Probably worth a whole nother conversation talking about AI to be able to put some of this stuff together. So let's go into an example because I want to make sure we get through the things we have here, right? We use IRR so we can actually provide an objective proof and transparency to the recommendations we make to you. That is also something then you can use to make objective proof and transparency to your clients. I know we are experts, right? As actuaries, as an actuarial-based firm, we are experts in annuities, life, and long-term care, but that means nothing to the person who's consuming it. I can't just say I'm an expert and you believe me. I mean, I guess you could. There's a lot of people that do that, but I'd rather prove it, and I'd rather have something substantiated behind that. So we put this out there of our assumptions, and you can agree or not agree with those assumptions, and we can change them, and you can look at the result and make a decision based on what you are provided, right? And again, this is powerful because this doesn't just apply to other people out there, right? Another wholesaler comes into your office and says, well, you should sell my product because it's cooler and it's got this roll up. We don't have to think that way, right? Show me what it is worth from an IRR perspective. If your wholesaler can't say that, answer that question, how do you know they have proof and transparency? Okay. So this is something you should be using across all aspects of the products you're looking at. Here's an example that I'm going to go to as it relates to annuities. So this is a risk transfer of a client not wanting to outlive their money. They just want absolute peace of mind that they're going to get their Social Security check. She's at the beach. She does not want to be worrying about if the market's up today, if Nvidia's up or down and they hit their earnings call and the market's swinging 5 or 10%. She doesn't want to worry about that interest rates are flying up and probably more volatile than equities are these days. She just wants to make sure that there's a check in her mailbox each and every month for the rest of her life. Okay. So this is just an example. She's got 40 grand of Social Security. She wants another 50,000 of annuity income. Maybe she's spending $120,000, $130,000. We're just solving for that $50,000 of predictable, guaranteed lifetime income. Okay. So how would I go about doing that? Now, this is going to be something we share down in the resources tab. You can actually go look at all of the illustrations. But if I'm talking to any purist, any theorist, they would say the easiest way to buy longevity, a lifetime income, is to buy an immediate annuity. And so we ran all the immediate annuity quotes. She's a 65-year-old female. For her to purchase a $50,000 annual lifetime income, she would have to write the insurance company a check today for $690,000. Now, that's the two data points you have, right? The present value is $690,000. The future value, because this is life only, meaning you die, there's no death benefit. You want to quit, there's no cash value, right? We took the actuarial triangle and shrunk it down. All of the value sitting up in that longevity payment, that's what it is worth. So a future value, you'll see here, the remaining balance column is always 0. And then I have a certain number of years. And this is where that one assumption we have to make is how many payments will you get? Now, I don't actually have to guess and only pick one because I'm actually going to show you all of them along the way. So this is a spectrum of what IRR could be depending on how many N or lifetime payments you get. Now, as a 65-year-old female, she has a life expectancy of age 90. She is expected, she has a 50% chance to get 25 payments. She also has a 50% chance to get beyond 25 payments, right? So that's the half, that average, that median, I guess you would say, of her life expectancy. If she lives to the exact age that she's supposed to, she would have put in the 690,000. She would have received 50 grand a year, which totaled 1.3 million. And if you did the IRR calc, right? So you go back to that equation, that would say it is worth 6.0% per year. What does that mean? That means comparatively, if you wanted to take the same 690,000 and give yourself an income stream of $50,000 for the next 25 years, you would have to earn 6% return on those other assets. Pull out your 50,000, the remainder earns 6%. Pull out your 50,000, the remainder earns 6%. So comparatively, that is the exact guaranteed return you would have in another alternative asset to match what this is giving you at your life expectancy. So when we pick an N in this example, life expectancy, age 90, I can then solve for I. Now, the cool thing here is in our tool is we can look at this at varying ages, right? If you live longer, you get more payments. If you get more payments and you still have the same present value, guess how the math works? Your IRR has to go up. You put in the same amount and you got more money back. Now, that is 25 to 30 years in the future. So from a present value standpoint, a time value of money standpoint, it goes up 0.7% per year, but that is over the entire duration. That's not just like 0.7 from here to here. It means the money from time 0 to that point did receive an inherent 6.7% per year. Again, same thing, you live longer, you would earn more, right? So this is a 1 out of 10. 1 out of 10 65-year-olds is going to live out to age 100. She would have put in 690, got back 1.8 million. That is the equivalent of 7.1% per year. So that's to the long side, right? That's living longer than she was expected to. But this also highlights the potential negatives of a situation. Because when we bought the pure life-only annuity and we gave up the DB equals 0 and the cash surrender value equals 0, if you don't live, you lose your money. And so what you see here is if this client didn't live to life expectancy, and let's say she died in year 10, she would have gotten 10 $50,000 payments. So that's the $500,000. She put in 690 and only got back $500,000. That is the equivalent of losing 6.5% per year on that investment, right? She didn't get back as much money as she put in. So until that point exists, the return on your money would have to be negative because you didn't get your money back out of here. Now you'll see the pure break-even point is when she gets paid back the amount she put in. So if you gave somebody 690 and then they gave you back 690, I think we all know that. That's 0% return on your money. You just pulled the money out from the mattress, right? So in a scenario like this, if she died in the first 14 years, she's guaranteed to lose money. Now, that is in exchange for maybe the fact that she wants to keep getting paid this money if she lives beyond 14 years. But you can tell that's a pretty big bet, right? That is a pretty big bet. Again, if she died in the first year, she put in 690, she got paid back 50, $640,000 is gone to her beneficiaries. So there's a lot of risk. That's all based on longevity, right? Longevity risk, okay? So I'm going to take a moment here. There's a lot of good questions because I want to hit those before we advance. There's a lot of math going on here, right? So when we talk about the math of IRR, the math of IRR is not the math of the insurance company. The math is not the distribution rate, right? So the distribution rate is the payment divided by the premium going in. Now in this example, right, what's 650,000 divided by the 690? If I do that on my math over here, that's a 7.2% distribution rate. That's one rate that the annuity gives you. The other rate that the annuity is giving you is 0% return on your cash value, right? So we also know we know that's not the embedded return. This is why that internal rate of return takes all of those other pieces out of the equation. And the only thing I care about is what was the value of the money that I put in versus the value of the money that I get out, right? And so the insurance company is the one who's willing to give you $50,000 if you put in 690,000. That's that distribution rate, right? So in that example, that's a key component. Another question I see here is 6% at age 90. Does that mean that if the 690,000 was invested at 6%, it would be 0 at age 90? Yes, I love IRR. Thanks for hitting that question, right? That's the equivalent of what an alternative asset would have to do to match exactly what I'm doing. If you had $690,000 today and you wanted to draw out 50 grand out through age 90, at that time you would have to earn 6% along the way. And at age 90, that bank account would hit 0. And when that bank account hits 0, your income also goes to 0 because it's a bank account. It's not an annuity with lifetime income. That's why it's cool, because if you think about this, if you live another year in the annuity, you get another payment. Getting another payment increases your return on investment from day one. So you think about this, you get paid more money and you earn more return, and all you have to do is live to get it. That is something no other asset class could replicate in your portfolio, right? And so this is that cool part of being able to increase the return over time, all right? Is there a refund option on this SPIA? Yes, there is a refund option if we wanted to buy it. But remember, she's out here on the beach. She wants 50,000 of income. The question is, how much money do I have to give the insurance company? If I wanted some cash refund and add a death benefit, the number I have to put into the insurance company would go up. And yes, that's value in or money going in, and it would be different value out. Now the refund would go to 0 at 700,000. So the IRR would actually go down if you live to your life expectancy, because you'd have to put in, say, 730,000 to have a death benefit until the premium went to 0. But you still only put in 50,000, but now you put in 730. So the IRR would have to drop to probably something like 5.5% for you to provide short-term death benefit protection. And so it's not saying either is right or wrong. It's just one of those things that there's a cost to the actuarial triangle, right? So that's what's cool about this. A couple other questions we're going to kind of touch over time. A lot of it has to do with inflation and increasing income. Obviously, we talk about that a lot, the present value of increasing income. I'm going to go through a couple other examples as we look at this. So in this example, it was the life-only immediate annuity. Over here, we actually go and we shop the lifetime income rider market. So fixed annuities, indexed annuities, variable annuities. And instead of annuitizing the contract with a single premium immediate annuity, I can buy the same lifetime income of $50,000. And based on today, I can actually save $30,000 from the most purest form of any longevity insurance that exists, right? All of the theorists want to say buy the longevity annuity. I'd say you're just spending extra money. And not only are you spending extra money, in the living benefit rider, I have a cash surrender value and I have a death benefit. And those are probably earning 3 to 4% interest per year. So now think about this. I spend less money. I get the same 50,000, but now I protect myself with the death benefit and my cash value is growing by 3% per year. If you look at the back of my t-shirt, I don't know if you can see that. That does say certified no-brainer, 1 IRR at a time. Okay. Same income, less money going in. Guess what we see? The IRR goes up. The IRR is worth more, right? So 6.5% per year is what you would have had to have replicated if you used 660 to buy the 50,000. But again, now you'll see that the IRR is protected if you die early because there is a death benefit and the cash value. So again, it's why we don't see a lot of immediate annuities right now, because I can buy better income with cheaper money and get extra benefits for my clients. And oh, by the way, you as the advisor probably makes twice as much with option number 2 here, right? So client wins, you win. Again, certified no-brainer. Now, if 660,000 is still too much money, one of the things that we could do is actually wait to start taking the income. So if we actually built the annuity in to start after 5 years, we need to understand that we would not get any income for the first 5 years. But you'll see, to solve for that same 50,000 of annual income, I only have to put in 230 or 430,000 versus the 660,000. So by buying the $50,000 starting 5 years from today, I'm able to save $230,000. Now, you don't have to send that money to the annuity company, but you do have to use that $230,000 to pay yourself for those first 5 years. 5 years of payments, $50,000 is $250,000. I got to make this $230,000 worth $250,000 over the first 5 years. If you did that math, it's probably you got to earn about 4% per year. And that's probably pretty doable, right? Now, the cool thing here is you'll see in this scenario, the IRR actually goes up even more. So by putting in the 430,000 to then generate 50,000 through your life expectancy, I've driven my IRR up to 6.7% per year. So if I'm leveraging dollars in versus dollars out, each of these scenarios, I'm getting more inherent return on my money. I still sell the risk off of potentially outliving my money. I'm creating the sustainable income along the way, but maybe I'm able to not concentrate so much of the portfolio into the annuity. Maybe she only had $750,000. Would I want to put 660 in there? Not really. So I can buy it by just deferring the income a couple years. So how does that logic work if we actually look a little further? What if we actually waited 10 years? So remember, this was now 430,000, right? Now I'm only saving 130,000 for waiting 5 more years. Before I saved 230,000 for the first 5. I only save 130,000 for the next 5. So again, client still has the predictable income, 50 grand a year, starting in year 10 now. I only have to put 300,000 into the annuity, but you'll see my IRR starts to go down. So what that's starting to tell you is by not receiving payments when payments are worth the most, the dollars you're saving up here, you're losing the value out here. It's still a strong IRR at 6% per year, but you're deferring the income too long. and the insurance company isn't bumping up the payment enough for each of the dollars going in. Again, it might be a reason to do that in an income plan, but again, you're starting to just reduce the value you might get from it. If I go to one more example and just waited 20 years, remember, originally we put 660,000 into the annuity to generate income from day one. It would only take 150 grand to start the $50,000 20 years into the future. So I've saved over 75% of the money I'd put in the annuity. But as you would guess, your IRR starts to drop significantly. You put in 150, you've only gotten 300 back 20 years in the future, or 20 to 25 years into the future. That's only worth 3.1% per year. You think about this, you would have to take, if you had 660, you would have to take $510,000 to provide yourself 20 years of $50,000. You would have to have 510 grow in a portfolio of $50,000 to get $1 million of total payments. You would have to earn about 8%. I just did the math on the side, right? So in this scenario, it's cheaper, but I'm actually putting way more stress on the money I didn't put in the annuity. That's going to be tough to earn 8% and provide myself cash flow years 5 to 10, 15 to 20. So in this scenario, what you're starting to see is generally with annuities right now, the way they're priced, your best option is more towards an immediate to a 5-year deferral. If you start waiting too long, that return on investment starts to go down. And if you really wait too long, it starts to drive down further. I'll just clarify this again. A lot of over disclosure. This is for a 65-year-old female that needs income today. This analysis might look different if it's a 72-year-old male or a 78-year-old couple who wants income to last for both their lives, okay? So again, just a little bit of idea, but all of this, the great part is we can break all of it down to the single number to provide the comparison for you. Again, different products, different annuities. What we can do is we can just get that data point at their life expectancy, and you can use that to make the decision. Generally, people want the ones that's higher versus the one that's lower, okay? All right, I'm going to touch a couple questions. I have one more example after we get through the couple questions. What does it look like if you had inflation, okay? So I'm going to answer that maybe in two different ways, all right? What if I had inflation, all right? One, I'm going to say, what if I bought an inflation income annuity, right? So something that has increasing income. Generally, if I wanted to buy an annuity with the 660,000, the inflation annuity would probably start at, say, $40,000. But then the income would be growing by 3 to 4% per year. So this could be the Allianz ABC, could be F&G, could be North American, could be Athene, could be whoever has the increasing income products, right? But you would see that the same amount of money in, your payment would start lower today, but in the future would grow. So maybe out here, it's paying you $80,000 to $90,000 a year. The great thing about IRR is it would net present value all of those cash flows and tell you what is the IRR of that increasing income stream. If I just ran an increasing income rider right now, it's probably at about 7.5 to 8% per year IRR at life expectancy. So it's generally a little bit higher than the guaranteed level income. But remember, with the increasing income, it's not guaranteed to increase. So that's how the IRR here is slightly higher, is because there are scenarios that if I only earned 1 to 2, I would probably end up lower over here. If I earn the 3 to 4 that I expect, it's going to be a smart move, and you've helped offset inflation, okay? So you can kind of see if I have an increasing income in this example, that's going to be a benefit to me. What about inflation in total, okay? Inflation is a concept that's outside of the investment that you purchase. Yes, if you bought a level income of $50,000, that $50,000 would buy you less over time. But that's independent of the return that you would be earning on the asset, right? you would still earn 6.5%. That's the same thing that if you tried to recreate it somewhere else, you would have to be earning 6.5% to pull out 50 grand a year. If 50 grand a year doesn't buy you as much in the future, that's not in the decision of what do I do with the investment today, right? That's going to be something we layer in as another part of a financial plan. Again, you could buy an increasing income annuity. I like this example where I'm going to save a certain amount of money. I'm going to let that money grow, and maybe I take pieces of it in the future from my portfolio or my AUM. Because once I put protection in this annuity and this account value goes to zero, I still have 100% confidence that my $50,000 keeps coming to me for the rest of my life. So for every dollar I don't put in the annuity and I don't need for income, you can be more aggressive with that money. Being more aggressive with that money pays off over the long term. This is that whole asset dedication webinar. So if you're thinking about what happens inside the annuity money and what that allows you to do with money outside of the annuity money, I'd encourage you to hop on the asset dedication webinar that I did a month or two ago, or we can hop through. We're building a tool to be able to do that. Last one, taxes. We don't have taxes inherently embedded in here. Yes, there is a difference between an exclusion ratio on the SPIA and the LIFO version of the income rider, but taxes is really just a timing of the money. So yes, it might help a little bit in the fact that the taxes are going to come, but you're always going to pay taxes on the money over and above the money you put in. So if you lived to your life expectancy, you will have paid the same dollar amount of taxes. They just paid a little bit earlier versus later, but that's also just going to depend on the actual underlying investment. So it may shift the IRR by about 0.1% at most. I'm going to guess like 0.05 in terms of the difference with the income rider. Because again, remember, in the income rider, in this example, you are only taxed when the money comes out, and you are only taxed to the extent that there's gains. So if you don't have gains, like, sorry, this one's getting a little messy here. Your first payment, you put in 660 and you pull out your first payment, no taxes. That is a return of your basis. That's actually better than the SPIA in that example, right? Now you didn't get gain on your money, so your cash value is going to go to zero quicker, but there's a trade-off there, okay? So again, maybe a little deeper we can go to. The last thing I want to touch on, because I know we're kind of bumping on time, is this idea of long-term care. So again, same client, she's on the beach, she's got her money coming in the door. She does not want to be a burden to her family. She wants to know that when she needs care, care will be given. And it may be her family, it may be in a facility, it may be a nursing home, but the fact is she wants her pool of money to be there. So what can I buy? And should I buy it, or should I just keep my money and grow it and pull it out when I need it, right? Active risk management versus passive risk management. Again, a little bit of something we touch on in the blog. So here's an example. This is a pretty basic linked benefit or LTC policy that we would look at today. If she wanted to buy $4,500 per month of long-term care coverage with 3% inflation on the benefit, she would be able to buy that with a lump sum of $95,000 today. Okay, this is a linked benefit, so it's a life LTC policy. If she died any along the way, we've kept the death benefit low because I don't want value or the premium to be too much into the death benefit. But when she triggers claims, look at that. Her first year of claims, she's recovered her entire premium she put in. 1 year of claims, she's now positive to the insurance company. 2 years in claims, she's doubled her money, and you would see she has 6 years worth of benefits in this example. That's what we bought, 72 months. She would have $630,000 of benefits paid to her. If you tried to do that on your own by growing your $95,000 to generate $640,000 of tax-free money in the future, you would have to earn 8.8% each and every year for the rest of your life on the money. And actually, it would have to be higher than that, because this $630,000 down here is tax-free. So if you were going to do this in an investment account, that would actually probably have to grow to like $800,000, pay your $150,000 to $200,000 in taxes, and then have $640,000 to spend on care. That's probably the equivalent of 10 to 12% return per year. So I simply ask, why would you self-insure if the break even is a 10 to 12% return? Okay. Not only that, that's if she actually triggered at 85. If she triggered those benefits sooner rather than later, that return is going to go up significantly. I just looked at a study. It was on LinkedIn. I posted on it. It's coming from One America. 55% of people's initial claims right now are Alzheimer's and dementia. That doesn't happen later in life. This is not just nursing home insurance. This is protection about providing yourself care, okay? And that's going to happen earlier versus later, and that would be worth your money there. The other thing that I'm going to have a comment on here is this one that I'm doing here is an indemnity policy, meaning when you can't do your 2 of 6 ADLs or you have cognitive impairment, you get the full monthly benefit. You do not have to have a reimbursement. You do not have to have a receipt. You do not have to go into a nursing home. It does not have to be a licensed caregiver. And so in this example, this can literally be my spouse. And I just can't do my 2 of 6 ADLs, but maybe my spouse can help me. The insurance company is going to send you a check for $100,000. And then maybe your daughters or your sons or your grandkids help take care of you. This money is cash indemnity. So now you are highly likely to pull out the $630,000 tax-free for the money that you're putting in here. If you didn't want to write a check to the insurance company as a lump sum, instead of $95,000, it would probably cost you $11,000 as a 10-pay. You can do that. You can use your HSA dollars, which are pre-tax money going in, and now I have tax-free leverage on the way out. It is the smartest thing you can do with your HSA dollars is buy long-term care coverage, which produces more tax-free money, right? And so you can just see here, IRR gives you this benchmark to say, dang, that's a really high number. And then I got to gross that up for taxes. If I'm trying to do this somewhere else, I got to be generating 11, 12% per year. That's a big return on my money. Okay. So I'm going to take a look here. One last question. Hopefully I can address it, and then I'll get everybody on the way. Is this LTC available in California? Yes. Some variation of it, right? In this example, I think I went through Securian. We'd probably use Nationwide, maybe Securian in California. So both of those are indemnity. One America just did a repricing, so they're more competitive in there. They are a reimbursement model, but they also have unlimited lifetime coverage. So it wouldn't actually stop after 6 years. A couple trade-offs to decide what you want to do there. But again, just a couple examples. So, all right. So with that, I know we're kind of a little past time here. I'd love for you to go out and use IRR in your case designs and with your clients to put objective numbers behind your recommendations. It doesn't mean you have to show your clients the IRR tool that we have. If you're interested in our IRR tool, we have that in Actuary Lab on our Core Connect website. Everyone on here has access to that Actuary Lab, and we can do that. Or you can ask us to just run your quotes, and we will create the IRR tool that represents what that present value of cash flows is worth. So you can reach us at our number, 800-541-7713. We got info at Core Income. Obviously, I'm Dan at Core Income. You can call me at any times. Last thing I'd do is just encourage you to look at a couple dates out here for the second half of the year. We're actually going through an office remodel and expansion here at the first half of the year. So we've had to slide our insurance intel events here for 2025. But in July, September, and November, you're going to be 40 to 50 like-minded advisors going through some of the things we talked about here, but also ways in which you can brand or market your business. Know what other advisors are doing for client acquisition. If you have your I Love IRR t-shirt, bring it with and wear it. Again, I'll just throw that out there. If you have your t-shirt, send us a photo. We'd love to have it. You can see the little QR code there. If you just want to scan that, it'll take you right to the registration link and you can put it on there. Do I mention that there's no cost for you? Say we pick up the airfare, we pick up the hotel and the meals. It's a day and a half of an investment and a commitment in your business to know that you are providing your clients the best options that are out there. Today was very much about the mathematical side of showing the objective proof of the best options that are available out there. But in reality, our number one objective is to maximize confidence. We want your client sitting on the beach, knowing the income's coming in the door, markets up, market down, rates up, rates down, Nvidia up, Bitcoin down, right? None of that enters the equation. Confidence that you're delivering a paycheck for the rest of their lifetime. Confidence that if they ever need care, family or professional, it's going to be paid for. It doesn't draw down all of their net worth and other illiquid assets, right? So that's going to be the stuff we go through there in Insurance Intel. So with that, I'm going to wrap that up. Appreciate you hopping on here today. The recording's going to be coming out. You're also going to get another email with a couple of those white papers or blogs that I mentioned, how to use an actuary in your firm and how to use risk management to produce client confidence in your practice. Look forward to those coming out. So again, thanks for hopping on. If you want to set up one-on-ones or give our office a call, definitely reach out to us. We'd love to be able to connect with you. So otherwise, have a great day. And I love IRR.